the price you're looking for. And if you add the interest on, we're actually paying you more over the course of several years than you'd actually be getting with this, straightforward offer here. So there's kind of like the price we want, and then here's the price you want, plus a little extra interest. You just have to, keep some money in the deal, basically. So
welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny, and I'm joined today by Daniel Krueger. Dan is a full-time entrepreneur, investor, and coach who is passionate about helping others become financially free by investing in apartment buildings. Besides providing lucrative investment opportunities, his mission is to help educate investors in financial literacy so they can take control of their financial future. Before beginning his full-time career in real estate investing, Dan spent 5 years in corporate finance, where he managed the operating expenses for multinational Fortune 500 companies. Since then, he has grown his real estate portfolio by over 500% annually. Dan, welcome to the show.
Thanks for having me. Excited to be here.
Absolutely. Likewise, very excited for today's conversation. You guys may recognize his name. I've had his partner on, Anthony, incredible episode as well. I believe it just aired recently too. So definitely check that out. They wrote the book, Passive Investing Made Simple. I've talked about it on here before. So a lot to get to, but let's kind of go to the beginning here. You worked in the corporate world for a while. Kind of talk about, getting into that and what's led you to where you're at now.
Yeah. So I grew up in a family of artists, and so growing up, it wasn't really there wasn't any pressure to go to a university and go the traditional route per se. However, I did get to kind of see the starving artist lifestyle, and that, there's not a lot of money around if that's your passion. So, I mean, if you love it, great, but that's not really a great way to make a ton of money. And so there was some financial stress that I was exposed to at a young age, and I got the perception from my parents, specifically from my mom, that it might be wise to look into getting a job at a big company and getting benefits, right? That's something that they never really had while I was growing up. And so that kind of stuck. And I eventually did go that route. Again, not by any pressure from my parents. They were like, do whatever you want, but just so get some health insurance too while you're at it. So I went that route, went to school for finance, went initially to thinking I was going to be in like investment banking or trading. But, when I graduated post 2008, there just wasn't a lot of that kind of stuff out there. So I ended up in corporate finance. And within a few years of getting into that space, I realized it just wasn't really scratching an itch. I didn't really know I had an itch, but I knew it wasn't really doing it for me entirely. So I started a side hustle while I was in the corporate world, and realized that I had this entrepreneurial bone in my body, that I really enjoyed that. I love building something and being in control and taking on a little bit more risk with a little bit more potential upside. So the entrepreneurial bug got sparked there. And it was shortly after that I started going down the real estate rabbit hole. And the last year of my corporate job was very much doing a lot of deal hunting, a lot of underwriting while at work. And and then it was off to the races after that. I found my first property, exited the corporate job, and just been doing the same thing ever since.
I love that. That's awesome. And so a lot of people wait until they really have the ball rolling to leave the corporate world. What was it that you were willing to just go do one deal? And, listen, doing a deal is obviously super important, the art of the first deal, but typically not going to pay you what a corporate job probably was. So 100%. What was it that made you just like, okay, I'm going to go do it?
I had that side hustle going. And so I'd gotten that up to the point where it was pretty much matching my corporate salary while I was working there, but it wasn't scalable. It was a nutrition consulting business. I was selling my time for money, and it was good enough to get up to that kind of corporate level, but that's where it was really kind of plateauing. And either I'd have to deviate and create something fairly cookie cutter, which just was not in line with what I wanted to do when I started that. So I realized that it wasn't a scalable option, but real estate was. So that first year, I did one deal my first year, small little 6-unit value add opportunity, which was great first deal. I learned a lot. but it was by no means paying the bills in that first year. So it wasn't until the second year where I got a few more properties under my belt, had some investors coming in, that there actually started to be enough income to actually kind of start to live on. And it was really year 3 and year 4 where things actually started to take off. And it was actually a viable income source, but it takes a little while to get it up and running. So unless you do something really monstrous for the first deal, the first couple, you have some other income going on too. If you're doing it yourself, I definitely suggest that.
Yeah, absolutely. And they don't tell you how hard it is to do your first deal, but there is something magic that does happen when you do it.
Yeah. I mean, you get it figured out on that first one. You figure out all the stuff that you don't want to do, right? You get a lot of your mistakes in on that first deal. But yeah, once that one happens, and I think something switches mentally where you realize that it's actually possible, becomes a reality, then it's like, okay, let's get the next one. After you kind of cross the hurdle of doing the damn thing, it's like, okay, this is doable. Let's do it more, bigger. So
absolutely. I love that. And so what have you identified as your role in your partnerships and growing the business?
Yeah. So I really lean into the kind of quantitative analytical side of things, which is my personality. I love building out the models. I love overseeing the property management and really fine tuning that machine, because I really cut my teeth on it in the first year, and it's been one hell of a learning curve ever since. And if you get that piece figured out, we manage in-house. Not everybody does that, but if you want to do it in-house, that's going to take a lot of attention, a lot of your bandwidth right there. So I really enjoy fine tuning those boots on the ground operations, really maximizing those budgets and our performance, and seeing how much juice we can squeeze out of a property, so to speak. And the finance side, the model building, the underwriting, all that stuff is really my sweet spot. And if you couldn't pick it up from Anthony's episode, he's really on the marketing side of things. He loves that part. We could both do either side, but he doesn't really enjoy the stuff that I'm doing, and I don't necessarily enjoy the marketing side as much as he does. So.
Yeah, absolutely. And it's so important to have that cohesive relationship where you sort of have your lane defined, and that's what makes it a great partnership and allows you to scale and grow.
Absolutely. So if you get two of the exact same guy, there's stuff that's not going to get hit, and there's probably going to be some friction. So ideally there's some kind of offsetting complementary skill sets, which is what we got, which is fantastic.
Absolutely. Complementary. That's the word I was looking for. Yes. Very complementary skill set is necessary. I can tell you firsthand what happens if you're both exactly the same. Deal absolutely went south and I lost money. So
yeah, I mean, partnerships are tough. I'd say they fail more often than they work. So I always tell people, take it slow, try to keep it organic. Don't try and go out and force them. Like if something just happens to make sense, run with it. That's exactly what happened to us. Neither of us were looking for partners. It just, after spending enough time together, it just all seemed to kind of fit together. We're like, hey, we both want to go to the same place, same speed, same style. Let's do it.
Absolutely. I love that. And so now we're headed into, some economic challenges. Subjectively, there's always a challenge, right? This one just happens to be, I think, more mainstream in terms of it's so obvious to everyone, right? Interest rates are going up, inflation. What, if anything, is changing in your guys' strategy, for acquisitions and things like that?
Yeah, well, I mean, we're in the middle of buttoning up a large deal now, which is, can't talk much about it because it's in process, but that's going to keep us pretty busy for the majority of this year. And we're kind of looking at the next 6 to 12 months very cautiously and getting prepared for it to get really tough for deals to pencil out for about the next year or so. And I pay attention to a lot of economic data, and things like the yield curve are implying that there's going to be a bit of an overshoot with the interest rate action that we're seeing right now. And in the next, 2 to 3 years, we should probably see some kind of mellowing out of things, meaning the Fed's probably going to go a little bit too hard and have to dial it back a little bit. So in our minds, we're kind of looking at the next year here as potentially a great time to kind of sit on our hands and watch and be very kind of cautious with what we're doing. Because it does get tough. If you're used to 3.5% interest for your cost of capital, and all of a sudden it's 6%, the deals that looked, pretty good before don't look that great anymore. And you really need those kind of Goldilocks deals that are just home runs for it to make sense. But with that said, there's going to be opportunity. I think every time this type of stuff happens, those who are ready and watching and looking for the right things are going to be very well positioned to capitalize on that, because there's an enormous wealth transfer happening right now. If people are ready and they're not over leveraged doing marginal deals, then they can capitalize.
Absolutely. And what do you foresee those opportunities looking like?
Mm-hmm. Well, the stuff we're focused on right now, because we invest locally in our backyard, is really those leaning into those local old guard owners who have been in there owning and operating these local assets for 15, 20, 30 years. They're getting to a point now, especially with where things are at in the markets, where it doesn't make a lot of sense for them to keep holding. They might have another 7 to 10 years at the most. And they're looking at the next few years thinking, man, if I'm going to sell, it's either now or in like 7 years. And a lot of those guys are opting to kind of move out a little bit quicker and kind of move into retirement. And that's really what we're focused on, is trying to position ourselves to take advantage of that transfer of wealth that I mentioned before, and be prepared for those, because it's those really strong relationships that we formed that allow us to find some really great opportunities, because they're not publicly marketed, they're off market, and they make a lot more sense when you're not in a bidding war against some 1031 exchange investor who doesn't care if he makes money. He's just trying to avoid a tax bill. That's a tough guy to bid against.
Yeah, absolutely. I love that. And that, just like you said, goes to show how important relationships are and maintaining those relationships. So for those, let's say, are new, right, and are looking to get into this, what are some things that they can look for and some economically and things we can look at to find some opportunities?
Yeah, I mean, aside from the relationships, I mean, that's honestly everything in real estate as far as I'm concerned. If you know enough people and enough people know you, you're going to be set up pretty good. So I'd say for newer people, really focus on those long-term relationships. Try not to be too transactional while you're out shopping for properties. Don't just think about the deal in front of you. Think about, okay, what else does this guy have? What are his plans over the next several years? Take some time to really get to know some of these local owners, or not necessarily local, but owners that are owners wherever you're transacting. I know a lot of guys invest out of state. So really take the time to focus on the long-term relationships. Don't get too caught up in the short-term thought of trying to make as much money on this one deal right in front of you. Think about, how can you position yourself to be in a good position with that person in the future. So as those things start to sell in the future, you're the first call, not the broker. That's, I think, the first thing newer people need to be focusing on is don't be too transactional, build long-term working relationships, because that's how you make money long-term, I think. And then as far as data, I really pay a lot of attention to the Fed. I mean, that's really the big million-pound gorilla in the room. When those guys make changes, the market moves. So try to block out the noise, focus on what the Fed's doing, and focus on things like the yield curve. It's actually a very good indicator of what's coming down the pipeline. You can see if there's things that are going to be changing, and make sure you position yourself and don't get into short-term debt. Make sure you've got a lot of options with your debt on your property so you can pivot and change. So it's probably not a good time to get into some highly leveraged short-term bridge debt that's going to be maturing in 6 months, where you're forced to make some sort of capital decision. You want to have some nice longer-term debt, even if that means it's a slightly higher interest rate. You really want to have that optionality for the next several years, so that if you just need to sit there on your hands and wait, you can do so.
Yeah, absolutely. I love that. Very, very good perspective. And on the investor side of things, obviously sentiment is wavering. What are some things that either you're hearing from investors or talking to your investors about to keep them still, bullish on commercial real estate?
Yeah, it's interesting because for the past 6 months or so, we've seen this kind of steady downtrend in the general equity markets. And so that's been kind of a nice little advertising mechanism for what we're doing. Because for the past several years, trying to get people out of the market and into real estate was kind of tough. Everything was going up 15, 20% a year. And a lot of people are just thinking that that's going to keep happening. But the last 6 months or so have been kind of an advertisement for real estate as far as the equity market's concerned. So the main kind of points of concern that we've seen aren't from the public markets taking a downturn, more so from the rise in interest rates. People are looking at that and saying, how does this make sense? Isn't this going to crash the market? We like to look at a scenario in all the deals that we do where we do have a refinance midstream there, and people are seeing us refinancing at anticipated higher rates. And like, why does that make sense? Because most people are used to their single family home mortgage, where typically you're refinancing to get better terms. But, we're trying to take some chips off the table there. So it's really, for us, it's been about coaching people on two fronts. One, the logic behind doing a refinance and the fact that it's an option for us. It's not mandatory, but assuming the market is appropriate and it's economically viable to do it, we'll definitely do it. But at the same time, the rising rates is actually still going to kind of help us. Yeah, it makes it tougher to underwrite deals, but it makes it also tougher to go out and buy a home. And so you're going to have a lot of people getting priced out of the housing market because prices have been going up like crazy, and now interest rates are going up. So the cost to actually get into a home is going up substantially. And there's a lot of people that are going to turn into renters by default from that. So what we're probably going to see is that, if you're trying to flip something quick, get in and out in a couple of years, trying to sell, you might not get top dollar with higher borrowing costs, but the rental market should benefit from the rising cost of interest, from rising interest rates. So I always point back to 2008, 2009, the kind of C, B minus class assets in our area that we focus on did really well during the biggest real estate crash ever. And that was because a whole bunch of people who were in houses became renters. And yeah, rent increases kind of slowed down for about a year, but occupancy went up, vacancy came down, net cash flow actually improved there. So it was only those guys who were trying to sell when the credit markets were dried up that they had issues. But those guys who were not over leveraged, had long-term debt and optionality, could just sit there and cash flow and wait for things to rebound. So
absolutely. Do you see a plateau of rental increase coming in the near future?
Yeah, I think so. I mean, there's a decent amount of inflation. I think the Fed is probably accomplishing what they want. We've seen oil come down from about $1.20 a barrel down to $120 a barrel down to about 100 right now. And so that hasn't shown up yet in the CPI reporting. So we're probably going to see a slight uptick in this month's reporting, which is based on last month's data when it was still 120 a barrel. But as soon as oil comes down, that is a big factor in the inflation calculation. So that should help cool things off a decent amount. And that's going to impact the residents in our properties dramatically, because it's really the cost of housing and the cost of food and the cost of fuel that are their limiting factors. So if one of those three is coming down, that's going to help the story. And hopefully we see that with all consumer products and food at some point here. But at least oil seems to be headed the right direction here, which is good. But I think that is going to change, because we're going to start to see that 3% unemployment turn into 4 and 5, which, as employers, that's actually good. We can get more talent in the door. Finally, it's been an uphill battle in that department. But assuming we start to see unemployment rise again back to more normal levels, we're probably going to see the financial wherewithal of people start to kind of max out. Now, that's going to be market by market. In our area, the cost of living is substantially lower than, not substantially lower, but I'd say we're kind of middle of the road. There's a lot of areas in the country, specifically kind of the Sun Belt and those hot markets, where people are already pretty much maxed out on the proportion of their income they're putting towards rent. Whereas in our area, I think we're around 20% or so. And that can go up to 30% before people are getting stretched. So in our specific area, this is another thing people I think need to look at, is what's the cost of living in your area? How much disposable income do people have? How much of their proportion of their income are they spending on rent now? Because that's really going to be the limiting factor. If you're up there near 30%, there's not a whole lot more people can afford. But if you're down 20s or mid 20s, there's still a little bit more runway. So every market's going to be different, but I think that's really the thing to look at, is unemployment and then what people's cost of living is in your area.
I love that. Thank you for that insight. What finally does stop the increase? People just start moving out because they can't pay it, or what kind of like really initiates that to where it's like, okay, we can't keep going up?
Hopefully that's it, because that's just market equilibrium taking place. Prices are going to go up until buyers lose interest and they walk away, and then they come back down, and you're in equilibrium, and that's what we want in a functioning economy. Ideally, it's not through some sort of government intervention like rent controls. That'll happen around. It doesn't work. Anybody who's studied economics will always find that that's not the outcome that happens. So hopefully that isn't the thing that happens. Hopefully the market just finds its equilibrium point. And if that's the case, then like I said, as long as you've got a nice delta between the proportion of people's income that's going towards rent and what they could be putting, as long as there's a gap there, you've got some room to increase things. But I would say that even though we've got inflation right now, I would expect that to become a little bit more difficult in certain markets.
Yeah, absolutely. You're definitely starting to see it. I mean, I'm sure you obviously pay attention nationally. You guys are typically only investing in your backyard, but I think I was reading an article that Phoenix is potentially, or even Austin, potentially experiencing what could be a bubble when it comes to rent. Seeing the same thing, anything like that?
Yeah, I've seen the movie before. I was in college at the time, so I wasn't paying that much attention. But in 2008, it was those markets that were great on the way up, or always the roughest on the way down. That's why we like the Minneapolis-St. Paul area in particular, because it's always just kind of slow and steady, consistent growth. It's not the most exciting numbers to look at for the past 10 years. It's just, very reasonable growth, but that's very sustainable. And those types of markets, there's a lot of them across the country, typically fare pretty well in downturns, especially markets where you've got a very broad spectrum of industries and you're not too tied to any particular industry. If you've got a diverse job market, people want to be there, and you didn't go up too fast, basically, you should be pretty well set for any kind of downturn. And like I said, as long as you've got some forgiving debt where you don't really need to do anything, you just sit and wait. That's how you do well long term. Just be prepared to sit on your hands for a couple of years. If times are tough, cash your cash flow checks and just wait.
Absolutely. Yeah. And a nuanced stat that not a lot of people talk about is that diversification of jobs, right? You don't see too heavy in ones, especially tech, which Austin is
a lot
obviously
of layoffs there now.
Yeah, experiencing, because that is a very sort of hybrid kind of, they don't have to stay in Austin to work for a company in Austin, right? And so you could see a very large migration of people out of there, which, you see it in, Vegas wasn't really a good example, but I think Vegas will probably experience it again because they're just too heavy on the service industry and things like that. But it'll be interesting to see do you think there'll be some opportunity for some distressed assets? Do you think there's some of these markets may have like an asset bubble?
I guess when you say distressed, you mean just completely let go? Or...
Well, I don't mean like, no, I don't mean just more like, operators who, didn't, interest rates just can't keep up with it, certain things like that.
Yeah, unfortunately, I think you probably are going to find some people that just didn't think that 6% interest rates were a thing that was going to happen. We all hope they don't get to 6%. They probably will. I know on the, single family mortgages, they're already damn near close to that. At least on the stuff we're getting, we're still, mid to high fours, which is, doable. And depending on where you go, I hear stories about certain banks around the country, typically regional banks that just hadn't lent enough in the past, and they're still doing it in the low fours. But yeah, I think unfortunately there's a lot of people out there who are newer to things and they haven't seen a true downturn. We saw like a little couple month preview in 2020, but we haven't really seen a drawn out version of this yet. We haven't really seen rates come up like this before. Not while I've been active. I haven't been active that long, but unless you were doing deals back early 2000s or late 90s, like you probably haven't seen high single digit interest rates. And so that's going to be a new paradigm, and it's probably going to catch some people off guard. That's what I was mentioning, kind of get ready over the next year. So I don't think there's going to be a big crash where you go shopping, but for those who have some liquidity, there should be some opportunities to help some people out who need to make an exit for one reason or another.
Absolutely. Couldn't agree more. I just think with how much capital there is now, whether it's on the sidelines or, like you said, you guys are kind of just sitting on your hands. I just think that you're not really going to see a crash because that capital is just going to come in and prop that back up pretty quickly. I think it'll be, as much as, and I know you guys are obviously, as much as say you're sitting on your hand, you're still keeping your ear to the ground, ready for an opportunity.
Oh, yeah.
And so I just think that, if you're doing that, those opportunities are going to come, you're going to snatch it up. And,
Absolutely.
like you said, you're not going to be shopping.
Yeah. We're just looking at things through a more pessimistic lens, I would say. So when we're underwriting things, we want to make sure that we underwrite for, basically worst case scenario for the next couple of years. And if a deal works under, in a worst case scenario, then great, we'll do it. It's just that worst case scenario is a higher hurdle now than it was a couple of years ago. A couple of years ago, a worst case scenario wasn't 6-7% interest rates. We didn't really have that factored in. Now that's got to be something you take a look at. And like I said, it's, those deals that worked a year or two ago, when you stress test them, they won't work today. You're going to have to find kind of the cream of the crop, I think, for something that's going to be, a real safe bet. Or you could just YOLO it. I wouldn't suggest that, but
this is by no means investment advice.
No, don't do that.
YOLO it. Oh, that's great. Yeah. I completely agree. And they'll come, right? They'll be there. It just obviously transaction volume just naturally has to decrease. I still think seller sentiment needs to change, and they need to kind of get used to not being able to just name their price anymore.
Yeah. I think it's going to get a little tougher on that end, but I think you're going to probably see an environment where some less traditional financing might start to make sense. Like seller carrybacks and things like that. That's something we've always kind of, not always, but there's been deals over the past couple of years where we've thrown that out as an option to a seller, and no one really bites because they don't have to. But when you start to see rates rising and the cost of capital going up, and certain borrowers having a little bit of trouble getting a deal to work through the traditional means, you might have to start getting a little bit more creative with how you structure things if traditional bank debt isn't the most viable option.
Absolutely. Yeah. I was just doing an episode on this exact topic where these creative guys are, sort of salivating now because it's going to be their time to shine.
Yeah. If you haven't had Bill Ham on yet, I definitely would. He wrote the book on it, Creative Cash. It's all about the creative financing. So what kind of things did you guys throw out creatively? Seller care. Oh yeah, we kept it pretty basic, honestly. I mean, we'd be looking at going into a deal with like 75% leverage from a bank, and seeing if the seller could do 5 or 10%, just because we wanted to try it out. This was probably the most recent time we did this, probably at least 2 years. No, it was before 2020, so probably about 3 years ago. We didn't necessarily need that in there, but we wanted to try to kind of flex that muscle. So we kept it pretty basic. See if someone wants to do a 5 or 10% carry back, kind of use the pitch that, they'd reduce their tax liability in the year of sale and all that good stuff. And it was a seller's market. So they were like, no, go away. No, we'd still do the deal, but it just, there was no appetite for it as far as we could tell, but we tried very little. Bill's one of those guys who's really mastered that over the years and can speak to how to effectively execute that much better than we can. But
yeah, I think you're going to start seeing that though, and sellers actually seeing that the opportunity there, especially when you pitch it on the tax liability side, right? I think you're going to start seeing, like you said, this old guard sort of like, I don't want to go through another one of these, like, sell now or wait 7 years. I don't want to wait 7 years.
Yeah.
Then you present this sort of, hey, this also, and you may even be able to get away with an even higher percentage now and really decrease that. What's your goal here? Do you, can we pay you over 20 years? And, there's really some creativity that you're really going to start see happening, because we're still going to do deals, right? This doesn't just end things. I think so many people read mainstream news are like, the housing market's going down. You're like, not really.
Yeah. I think there's going to be a little a little dip, a little correction. It's not gonna be anything like '08. But yeah, one other thing I forgot from, this was years ago, but when we would present those offers, we would do it typically in, we'd basically make two offers on a deal. One was just the traditional offer. Here's the price we're going to pay, which was a lower price than what they were shooting for. And then we'd say, hey, we can give you your price, which is a slightly higher price, but it includes carryback. So, that was kind of the other angle we took with it, was like, hey, we'll actually pay you the price you're looking for. And if you add the interest on, we're actually paying you more over the course of several years than you'd actually be getting with this, straightforward offer here. So there's kind of like the price we want, and then here's the price you want, plus a little extra in interest. You just have to, keep some money in the deal, basically. So that's how we try to position it. Wasn't the right market for it, but I think sometime in the near future that might become a more viable option.
Yeah, absolutely. I completely agree. And it's nice that you have that opportunity, especially if you're in a market like yours, where there's a lot of that old guard. Utah market's the exact same way. I'm a little bit more on the self-storage side of things, which gives a nice opportunity with a lot of these mom and pops and things like that. So have a lot of those opportunities. Awesome. Well, I've appreciated this very much. We'll kind of wind down here. I've got 5 questions I asked all of my guests, so we'll jump to those. Best advice you've gotten from a mentor?
That's a good question. Best advice I've gotten from a mentor. Does it need to be a mentor that I know personally, or just somebody that I get a lot of? Okay. Yeah. Because the first thing that popped in my mind was a quote from Naval Ravikant. Not sure if you know who he is. Founded AngelList. He's one of those kind of older school angel investors out of Silicon Valley. Made a ton of money. Now he spends a lot of time philosophizing, but he did this famous tweet storm a while ago, which was how to get rich without getting lucky. A lot of just little sound bites of wisdom, specifically aimed at entrepreneurship and finance and investing. But one of his lines was play long-term games with long-term people. And that's just a core philosophy of ours. Like I mentioned before, we're very long-term focused. We focus on those relationships. We're not focused on those short-term transactions. So I'd say play long-term games with long-term people.
I love that. Yeah, this is a time where that's even more real, and you're going to see people who, it's going to weed out the ones who didn't set themselves up for that or don't want to play that game.
Yeah, especially in real estate.
Yes. Yeah, for sure. But this is a get rich slow scheme. You really shouldn't be getting into this if you think that in 3 years you're going to, be rich.
Yeah.
Yeah. Sorry, go ahead.
Oh, I was just going to say, I think it's a Grant Cardone thing. I'm going to steal, but it's, I think he said it's real estate's not get rich quick. It's get rich for sure, but it's slow. It's going to take a while. Probability of it happening is incredibly high, but give it a decade.
Absolutely. Absolutely. What is it about your career that makes you feel like you're fulfilling your why?
Getting to help people. On the investor side, we really focus on educating people and having them take control of their financial future. And it feels really good to share with people the opportunities that they have investing in the private markets that a lot of people just aren't aware of. They think the 401k and index funds are their best option, but kind of opening people's eyes to the wide range of possibilities out there has got to be one of the most rewarding parts. And then obviously fixing up our hometown and making it as good as possible feels pretty good too.
I love that. That's awesome. Favorite non-real estate or investment related book?
Non-real estate, but investment related. Is that it?
Or investment related. So
okay.
Non-real estate or investment related, self-help, fiction, whatever.
I would say there's a lot of them, honestly. The Almanac of Naval Ravikant I'd check out. It's just a big collection of all the Navalisms. That one's great for those who want some kind of philosophical business type of stuff. I'm a big fan of King of Capital, but Blackstone, just because it's all about the private equity structure. And there's so many parallels between that business model and what we're doing. There's a lot of great ones. We just did a podcast episode on our podcast, actually, on The Road Less Stupid by Keith Cunningham. That's a great one.
I've gotten that one before.
Yeah.
It's on my list.
Yeah. I got a laundry list of them. Yeah.
Do you like to read?
We do. Yeah. We're both avid readers, and we do, I believe, a weekly segment now where we do a deep dive on one of our favorite books. I think we're about somewhere between 10 and 15 in now. So
nice. That's awesome. I love it. If you could have any superpower, what would it be?
Time travel, a superpower?
Yes, absolutely.
Okay. Yeah, I want that one. That would be cool.
Would you want to change anything or just witness events?
Yeah, just witness. I don't want to mess around with that grandfather principle or whatever.
Right.
I've watched, yeah. I just think it would be cool. I've been kind of obsessed with that ever since I was a little kid.
History or time travel?
No, time travel. I mean, I'm really into history now, specifically like economic history. And that's another one, Basic Economics by Thomas Sowell. That's one people need to read if they have any questions about what the hell's going on right now. That is a really good deep dive on economics. And there's a whole couple chapters. Within the first few chapters, he hits on the rent control thing pretty heavily. It's very interesting. He goes very deep too.
I am yet to find a single economist who is an advocate for rent control, even those that, lean on the more left side of their viewpoints, they still disagree with it. There's just no data in its favor.
Yeah. So it's got the worst track record, but I mean, it sounds great for people who don't understand economics and haven't studied it. It makes a great headline. So yeah, but I don't want to get on the soapbox now.
No, totally. Yeah, I get it. Cool. Last one. What's the best way for people to get a hold of you and learn more?
Yeah, you can find me on LinkedIn, Instagram, Facebook. Just search for name. You could look for invictusmultifamily.com. It's our website. Multifamily Investing Made Simple is our podcast. You can plug that into wherever you consume your podcasts, iTunes, Spotify, whatever. That's most of the places, or around Minneapolis, if anyone's local.
And of course, don't forget to pick up the book as well. Yes. Talked about it in the beginning. Incredible book. Really, like you said, great crash course, you guys. If you want to just get a really good understanding of what's going on and what you're doing and what you're putting your money towards and why, it's right here. Mm-hmm. Dan, thank you so much for your time. I really, really appreciate it.
Absolutely. Thanks for having me.
Absolutely. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to KataniCapitalGroup.com to learn more.